A Bitcoin company managed by Bitcoin maxis that gives you a 13% dividend yield paid every single business day is pushing what's possible in the financial industry if you adopt a Bitcoin standard. And today I'm sitting down with Matt Cole, the CEO of Strive, the company that made that possible. This video has two very interesting angles. The first angle is you as a Bitcoin maxi can now use another tool in the Bitcoin toolkit which pays you 13%. Very interesting for emergency funds, very interesting for short-term to medium-term capital. And the second interesting angle to this video is how much massive capital this will bring into Bitcoin. This is potentially a 300 trillion, a 400 trillion, might even be a 500 to 600 trillion dollar market. If Strategy, Strive, and the Treasury companies can only get a very small portion, 1-2% of that, that alone would push Bitcoin far beyond the $1 million mark. Enjoy.
I really want to talk about Strive, the future of digital credit, all of those things. But maybe just before we start, give me an overview or give me kind of a background of who you are and why you're excited about Bitcoin in general.
Yeah, so I started my career in finance. I worked at the largest pension fund in America, CalPERS. It's actually more than $500 billion in assets, and I managed about $70 billion of those fixed income assets. So two different portfolios there, and actually both of them are really important for my background and what we do now, but about half of those assets were structured products. And so you think about Strive now, we're a structured finance company. We take Bitcoin and we structure it, create, the preferred equity SATA, which we'll get into, I'm sure, and the common equity, which is amplified Bitcoin, ASST. So that is just structured finance. That's what I used to do. I was managing about $35 billion of assets there, actively managed. And then the other half were US Treasuries. And so I was one of the larger buyers through CalPERS of US Treasuries in the world. And so what that means is I had direct access and talked frequently to the Federal Reserve, the US Treasury, to try to understand the landscape of US Treasuries because I was one of their large customers, right? They're in the business of selling debt, right? So they want to talk to large buyers of that. And so what was interesting there is, talking to the Treasury and the Fed post Great Financial Crisis in the era of QE, I became very convicted in the problem with the debt crisis of fiat currencies, in particular in the United States, because that's what I was, managing a portfolio of. And I just saw it as a problem with no solution. And I became very convicted that the United States government and the Fed were not going to fix the problem. And not only that they were engaging in money printing, which to your audience and to me would be like, yeah, no, obviously the Fed has through QE has been printing money, but in institutional circles, even that notion was challenged. They would challenge it and they would say, no, QE is not money printing. Here's what we're doing. And ultimately, what was happening was the Treasury would issue in the era of QE, they would issue new debt. And then they would sell that debt in the open market to Wall Street. So like, let's say Goldman Sachs. And then Goldman Sachs would sell it to the Fed when the Fed was buying Treasury assets. And they would say, that's not monetization of debt. That's not money printing. And they were actually technically true, but it's because it went through Wall Street, from the Treasury to Wall Street to the bank to the Fed, where if it just went directly from the Treasury to the Fed, everyone would agree that that was monetization of debt, that was money printing. And so it was like this weird technicality where they could, claim that they weren't doing what they were actually doing, which is, I guess, like smart engineering. But I saw it as a massive problem. That was before I was a Bitcoiner. So I saw the problem. I was like, this is a huge problem. But initially, this is like 2013, 2014, I rejected Bitcoin as the answer. And the reason is I actually first heard about Bitcoin on a bodybuilding website. And so imagine, you work in institutional finance, you're managing $70 billion, and you hear about magic internet money on a bodybuilding website. Like, it's just really hard to say that that's the answer. And so that was, my view of Bitcoin in 2013, 2014 was that it was silly. And as Bitcoiners know, everybody gets to buy Bitcoin at the price they deserve. I became a Bitcoiner late 2016, when after the crash of 2013, 2014, when Bitcoin didn't die, that was surprising to me. Like, I thought it was dying. I thought, I was like, okay, like, see, it was, it was a joke, and it didn't die. And I just like, why is it not dying? And that was enough to pique my interest to say maybe my assumptions are wrong. And right, because humans, if you're not continually learning and evolving, I think you're doing it wrong in life. And so I did a deep dive in Bitcoin in 2016. I started buying Bitcoin late 2016. And by early 2017, I had put my entire net worth into Bitcoin. And I viewed it as the only answer. And so at CalPERS on this, institutional desk, so I was, the fixed income desk and the equity desk was right together. I was the only Bitcoiner. And as like any Bitcoiner does, it's like one of the only things I would talk about on the desk. Everybody thought I was crazy. And it was real Bitcoiner. I joined Strive. Strive started as an asset manager, really pushing back against ESG and DEI. I think we won that mission. And so our company was co-founded by Vivek Ramaswamy. And if you're not familiar, he was the first presidential candidate in the United States to speak at a Bitcoin conference. Him and I spoke frequently about Bitcoin when he was at Strive, and I think I played a major role in helping orange pill him. And so it was just very natural for Strive when we kind of achieved our first mission to say what makes most sense, what is something we both believe in, a major opportunity. And it was transforming Strive into a Bitcoin treasury company that was all in. And so we've obviously learned and innovated, not only replicated, but innovated on top of the model that strategy has pioneered. And I think we're rocking and rolling.
Really interesting. And I've begun my Bitcoin treasury. Like, I've been in Bitcoin now since like a little over 6 years now, but I dismissed treasury companies for so long, and it's kind of almost an embarrassing of mine because I've never really looked into them till I think December last year. And so I've started a strategy. Obviously, I like to start with the biggest one to understand kind of the market. And now I look at Strive as a really interesting, innovative second. I don't like the word competitor because like the market is so new and so fast growing that they're kind of fighting for the same thing. So like I don't think you guys also think as each other as competition, but like technically like you're doing similar things. But before we get into all the fun stuff, maybe for the people that have no clue about Strive and what SATA and what Strive at ASST and what SATA is with the dividend payment. Let's start with SATA because I think it's like the foundation also for explaining what a Strive, the common shares is. What is SATA? What are you trying to achieve? And maybe for people that are new to the space, how the heck are you able to pay 13% interest when I get in my Austrian bank account 0.3?
Mhm. Yeah, so SATA is a perpetual preferred stock that currently pays a 13% dividend. The dividend is variable, and so it could go up or down relative to the demand and the risk profile. And frankly, we'll get into this, how much capital the company wants to raise, and we want to raise a ton of capital to buy a ton of Bitcoin. And all these different variables factor into the interest rate because the company is actively working to maintain the price of SATA in a 99 to 101 range. And so we're trying to the maximal extent possible, reduce the volatility of the perpetual preferred stock SATA, pay a healthy dividend, right? At 13% to your point is extremely attractive, and really appeal to people that obviously want, I mean, who doesn't want 13% with minimal volatility? But I would say like there, it's obviously this is not risk free, right? Nothing in life is risk free. But how we're able to pay it is actually structuring around Bitcoin, and so really it's a play on the fiat currency debasement that's happening in the United States around the globe, where the pace of fiat currency debasement is growing about, call it 7% a year. on average for the last 100 years. So that's a long-term rate of currency debasement. As I think most of your audience would agree with, I think we're in the late stages of the current era of fiat currencies. And so if you believe we're kind of in this fourth turning late stage era, and for the last 100 years, we've been debasing at 7%, you would probably assume that for the next 10 to 20 years, if that was the average, we'll probably be debasing more than the average. And so my view is that debasement will run probably 10% plus for the next 10 to 20 years in the United States. And I think that's pretty structural because you look at the underlying, you look at the debt crisis, you look at call it the off-balance sheet liabilities. So the Social Security, the Medicare, these things that aren't even part of the debt crisis, the budget, but contribute meaningfully to the liability. And that's just the pace that fiat currencies are being debased. And then you think about Bitcoin, and I think Bitcoin is still in its gold rush era. It's not, I don't view it as a mature asset having achieved what I think it is, which is like the perfect form of money, right? And so if it's still in this growth phase and it kind of gets into like Bitcoin could go up to infinity, right? Because the dollar's worth nothing, right? Like it doesn't it's kind of silly to say like, okay, like how high Bitcoin goes. Is it 250K? Is it a million? Well, I think it has a massive ability to increase in purchasing power. So like what one Bitcoin could buy, like in terms of like a house or a car. But in terms of the dollar, it's infinite, right? It's not infinite versus like where one Bitcoin will buy you, the state of California, right? Like, but it will buy you more. And so you combine these things and you say, okay, a company that puts Bitcoin on its balance sheet and underwrites that risk, the goal here is to create a win-win. And so on our common equity side, you have super Bitcoin maxis that, and this is where I would put myself, that I'm so convicted in the future path of Bitcoin. I want Bitcoin and I want ability to earn Bitcoin plus returns. Okay. So to potentially outperform Bitcoin itself and accumulate more Bitcoin. And so how this works is that our cost of financing with SATA is obviously 13%, right? And so there really is two forms of math for SATA. If Bitcoin goes up about 5.8, 5.9%, Strive could pay its dividend forever. Okay. So if you're a SATA investor, you're basically needing to underwrite that if you want to hold SATA for the next 50 years, that Bitcoin's going to go up on average just about 6% a year. That's a really low rate of return, right? So that's the credit risk for SATA. Okay. Now, I think it's also important to note if you're a common equity investor, if you're financing at 13% and Bitcoin goes up 6%, SATA will do really well. The common equity probably would not do really well, right? Because your Bitcoin's going up less than your cost of capital. My belief is that for the next 10 to 20 years, Bitcoin's probably going to go up on average about 30% a year, if not more. But anything over 13%, the common equity starts to structurally outperform Bitcoin itself because Bitcoin's going up more on average than your cost of capital. And so this is the structured finance trade that the company is putting on and creating two securities. One, SATA is designed to have substantially less volatility than Bitcoin, likely less return than Bitcoin if Bitcoin does what we think it does. ASST, this volatility, it's not magic. You take volatility out of one thing, it goes to the other thing. It's like energy, right? So our common equity will have more volatility than Bitcoin. And if Bitcoin does what we think it'll do, will outperform Bitcoin itself. So that's the structure. It's proving to be a pretty big win-win because there are a lot of people that don't want the volatility of Bitcoin. And I think sometimes as a Bitcoiner, that's some of the harder things to hear is that people don't care about the perfect properties of Bitcoin as money. They just can't handle the volatility. And maybe they're older or whatever. And SATA is the perfect instrument. But my belief is everyone should own Bitcoin. Everyone. I think that's just like a foundational belief as a Bitcoiner that I really do believe. And then based on people's risk return profiles, SATA or ASST can make sense as well.
I've heard that the first time with Seyr saying that if Bitcoin goes up, I think he said 2 or 3%, he can pay the dividend basically forever, or like 50 years or whatever he said. And now you say like 6% or like 5 point something for Seyr. I don't fully get that math because like you pay out 13%. Is that including with like selling Bitcoin that is already in the balance sheet, or like how do you get to the 6% number?
Yeah, so the base case assumption for this math is that for both Strive and Strategy is that neither company never raises capital again, and they take the Bitcoin on the balance sheet and they sell it. Now, obviously in practice, neither company has had to sell any Bitcoin, although right now Strategy might be selling some high cost basis Bitcoin. They've hinted at that at the last earnings call. Okay, so I'll get into the math for you, but that's an important assumption. And just to note that when the company is not doing that, so when Strive is able to leverage our common equity to do that, and Strategy as well, what that means is that we're finding a cheaper source of capital. So it's actually better than this base case assumption of assuming we just sell the Bitcoin. Okay, which obviously we're trying to not do. Why does this math work? Because the company actually is not 100% amplified. So we don't use the term leverage, even though it's kind of like a adjacent term to leverage. It's just to note that preferred equity is not debt. But like if you want to use a simplistic term, you could use leverage, but we use the term amplification to say, right now Strive is about 40 something percent amplified, which means that we don't have, we have more than $1 of Bitcoin for every $1 of SATA outstanding, right? So because there's more than $1 of Bitcoin on the balance sheet than $1 of SATA, then Bitcoin can go up less and we could sell Bitcoin because we're compounding like a greater pool of assets than the liability. So like if you were to simplify, like what would be the simple math? Let's use 50% amplification. That's more amplification than we have right now, but we would like to actually bring amplification higher. So maybe that's something that you'll see in the future if SATA grows rapidly with daily dividends. If it was 50% amplified, very simply, you would take the interest rate of SATA, divide it in 2, because we're 50% amplified, and that would be the minimum break-even return of Bitcoin in the future. So that's how that math works. But for the people that might struggle with the math, the reason that makes sense is that if Bitcoin only goes up 6% a year or 6.5% a year, the common equity will likely underperform Bitcoin. It's not magic, right? It's basically the common equity financing SATA in the scenario where for the next 15, 20 years, Bitcoin only goes up on average 6% a year. I think it's important to note that with the rate of fiat currency debasement, what that would mean is that Bitcoin is basically peaked. It's almost like a Bitcoin quasi-failure scenario in my view, right? If Bitcoin's only going up on average for the next 15, 20 years, 6% a year, I think that's a extremely bearish view. I don't have that view, but in that scenario, like I think it's, I think it's important to lay out just the math, right? Like here's how the math works, then underwrite your own risk profile. And if you believe Bitcoin's only going up 6% a year, SATA is a better investment than ASST, right? I mean, it's because you're getting 13% off of an asset that's paying 6% because the common equity would likely struggle. If you believe Bitcoin's going to go up 20, 30% a year and you can handle the volatility, then ASST is the more interesting play. But really, just to kind of reiterate back on SATA, like when we go talk to people about SATA, the calculation is for most people is not should I buy SATA or should I buy ASST? It's should I be in a checking account or should I be in my fixed income account or should I buy SATA and with the belief that Bitcoin's not going to go to zero, right? So it's just a different equation, but for a Bitcoiner kind of understanding the math, I think that understanding the play between them is important.
No matter if you already have self-custody or still have your Bitcoin on exchange, your generational wealth that you have in Bitcoin could be completely at risk. And that's why I highly recommend to you to give the Bitcoin Way a 30-minute free consultation call to check how secure your custody setup really is and what you can still improve. So head over to thebitcoinway.com/Robin. Again, that's the bitcoinway.com/Robin and get your free initial 30-minute call with the Bitcoin Way. Finally, we have BTC Prague back in 2026, and this year I'm not only speaking on a panel, but I'm actually going to present an interesting new angle, a perspective, a Bitcoin thesis at BTC Prague this year for the first time ever. I've never done that on any other conference, so this will be a fun one. If you listen to this show on a regular basis, I would love to meet you in Prague this year. It's very high signal, no noise, and Prague is just a freaking amazing city with awesome drinks and a lot of good food. Use code ROBIN to get 10% off, and if you buy with Bitcoin, you get an additional 5% off your ticket price. I'll see you there in Prague. Make sure to come say hi.
I just had 2 episodes ago an amazing talk with Rashad Soni, and he has like the CPA and all of that, and he's a solid Bitcoiner, has a huge channel. You might have seen him, but like he categorized with like you need an emergency fund, which is like cold hard cash, like 2 months, 3 months, 6 months, whatever your risk portfolio is. Then you have the 3 months to 4 years kind of category where he puts actually stretch SATA, those kind of products in there, because it has a higher risk obviously than cash, but it also pays a way higher yield. As I said, my bank offering me 0.3% is a very different number to 13%. Yeah, I have to pay taxes on that, but even after taxes, here in Austria I could probably still get like 9-10% or something like that, which is like astronomical. And then above 4 or 5 years, you have like Bitcoin and Strategy and Strive, like those long-term plays where you have 5, 10, 15, maybe even 20 years. For a young guy like me, I'm 27, I can look out 20, 30 years in the future and say like, okay, I want to buy assets now that I use in 20 years and not like next week. So I feel like it's almost a time preference question, or like a time horizon question of like what you buy. Is that kind of like how you also categorize them?
For the Bitcoin maxi, yes. And so I would put myself in that category. And there's a lot of people in that category, right? That looks at the duration of their needs for their assets, and then categorizes it like that. And that's actually how we've structured Strive as our own balance sheet. And so our own balance sheet, we actually have 18 months of dividend reserves for SATA. And the first 12 months of those reserves are actually just in cash, right? And in like money market type sort of funds. And the reason is because we obviously have a very large cash liability with SATA, right? And so we have 12 months of reserves there. We also have 6 months of reserves in Stretch. And some people struggle with the mental math of that. Is like, why would you, as an issuer of SATA, own Stretch? Well, there's different risks that we're trying to hedge here. And so one of the analogies to actually look at is that in traditional corporate space, what you'll see is that many corporate issuers of what's called commercial paper, which is very short-term paper, so like Apple, Google, Ford, they'll issue short-term paper, and then they'll also buy the short-term paper of another company. And you'd be like, well, why would you do this? And the reason is that there's sometimes exogenous risk to the system where liquidity just dries up. Okay, and your ability to finance things basically could go away, even though the solvency of these companies is still fine. And so that risk is a risk. And you think about, if the dollar is failing, like if that actually scenario plays out, and what would a dollar failing scenario look like? Well, you could imagine if the dollar's failing, that there's probably going to be a run on the banks, right? Like, I mean, like, have you ever seen a fiat currency fail in some emerging market where there's not a run on the banks? Like, that's almost just like a requirement for the failure of a fiat currency. And so if there's a run on the banks, any company's ability to raise capital through a bank, right, which is how any company does, could become stressed, right? So there's a scenario where Bitcoin does really well, but capital markets dry up. And in that scenario, it is nice to not have a cost of capital of basically earning nothing. So we've increased our reserves, right, in Stretch to say that there's some scenarios where we might want that. So anyways, we have 18 months, 12 months cash, 6 months Stretch, which is kind of what you're talking about on the individual level. And then we have a massive pile of Bitcoin, right? Where like if you were to compare our Bitcoin holdings to our cash and Stretch holdings, it's like almost all Bitcoin, right? But on a balance sheet perspective, we are looking into what are those short-term potential liabilities of the company, just like an individual would do as a Bitcoin maxi, and positioning our portfolio accordingly. So I think that makes a ton of sense to people like in your audience that are likely already Bitcoiners. And then to the normie audience that's not a Bitcoiner, it's different. We're just trying to move them off zero exposure to Bitcoin, and SATA and Stretch are great first products there.
It's actually it's actually a thought I had in my mind, how many non-Bitcoiners that are just interested in high income actually buy SATA, Stretch, and those products. Because like for Bitcoiner, if you have the need of medium-term cash, like SATA and Stretch is like a no-brainer. Like if you are convinced of Bitcoin, those products have like, of course, the risk with like management team, like it's a stock, like it can go up and down, obviously, but like the risk is quite minimal if you really believe in the management team and in Bitcoin. How do you see people getting into SATA that are non-Bitcoiners? Is that a thing? Can you track that in any way, shape, or form? Do you get feedback from shareholders that like, I don't want Bitcoin, but I love that you pay me 13% daily?
Yeah. So it's really anecdotal things, and so I could point to you, or not publicly, but like tens of conversations of millionaires that are like real estate investors, where they are actively selling or not buying new real estate properties and buying SATA instead. These are people that like maybe have one Bitcoin in cold storage. Like they're not anti-Bitcoin, right? What's really interesting about the real estate community, and I would say the gold community outside of like the Peter Schiffs of the world, is that these communities are actually already convinced of the problems with fiat currency debasement. Like you don't have to convince them. Like they see that problem, they've invested in that problem, and it's why they've invested in hard assets, right? And why they've gone down the routes of real estate or gold. And we've seen more breakthroughs currently on the real estate side than the gold side, but there's examples on both sides. But you look at real estate and you have investors that are earning 5-6% a year with a ton of work. And that's one of the things that we've heard most frequently from a lot of the real estate investors. It's like they feel like they have a job, like they're earning 5-6%, but like how much of that is from the capital side versus their blood, sweat, and tears putting into the property to manage it. And so for them, having already understood it, they like SATA because it's not volatile. That's the biggest problem that I hear from kind of the Bitcoin, I would say not like Bitcoin hater, but Bitcoin somewhat skeptic community of like, they think that Bitcoin's going to go up, but they're just like, I can't have an asset that drops 50% every 18 months. Like I'm 70 years old. And so that's their problem with it. And so SATA solves that problem, right? Because they don't think Bitcoin's a scam. That's, I think, the most interesting investors, because there's a lot of them that we've been encountering. I know Strategy has as well, that have been allocating to Bitcoin. We've done a couple normie conferences where myself, our chief risk officer, Jeff Walton, chief investment officer, Ben Workman, will go talk to just like an income investing crowd that will invest in real estate. They'll invest in oil and gas assets. And every time we've done that, there's people that are like waiting to talk to us afterwards. And some of the feedback we hear from them is they can't believe that they can just log into their brokerage account, their Schwab account, their Fidelity account, and just buy a ticker that pays them that, because these are like typically like pretty affluent people. They're used to having to sign up to some, private credit, sign a bunch of, accredited investor things, and they're super interested in it, but they're also shocked that there's no fees, that it's just such a better product than what they're used to seeing. And so I think you correctly highlighted that, you obviously have to have a, belief in, for SATA, that, Bitcoin's not going to die, which is super easy for your audience, but like, for other normies, that's actually, a thing. And then some belief in the management team. But when you compare that to what they're used to, right? They're not used to I'm buying a bearer asset that has, no counterparty risk, no CEO. They're used to buying some private thing that like blows up all the time. The faith you have to have in management for those investments is actually substantially more than the faith in management for a product like SATA or Stretch. So it actually is a very easy sales process. And I think it's just going out and telling the world is really what we have to do.
I personally think like digital credit is the biggest innovation since Bitcoin itself in finance. Obviously Bitcoin is the bigger idea because it's the foundation for digital credit, obviously. But since then, like I couldn't think about anything that is as genius as digital credit itself. And I asked that question about like what's the crowd that buys that? Because I personally think right now it's probably mostly Bitcoin or Bitcoin adjacent people. But I could imagine in 2, 4, 6, 8 years when the products are more mature and have a track record, that a lot of income craving crowd, a lot of retirees, a lot of people that just want to have a savings account that pays them anything above 4 or 5%, like even 7% would be amazing. 13% is like double that. It's like amazing. So I think as it will be really interesting to see how those products mature over time and how much more volume it can attract. Like there's so much money in private credit, in the bond market, in the money markets fund. It's unbelievable. Give the viewers a little bit of a, because I think it could be interesting. Give the viewers a little bit of a an overview of how much capital there is in bonds and private credit and all those kind of like bubbles that SATA is kind of like attacking. Attacking might be a little bit of a hard word.
Yeah, yeah, I think it is a friendly attack on the system, right? That's what Bitcoin is as well. And as Bitcoiners, I mean, that's part of, I think, what ultimately has to happen here. The credit markets are $300 trillion, and so that's global credit markets, massive. And so I think one of the interesting things about the innovation of digital credit, and I do agree with your point that outside of Bitcoin, it's the biggest breakthrough innovation in financial markets in a long time. I don't even know how long, but it's a massive breakthrough innovation. And so you think about that, okay, $300 trillion market. What if digital credit took 1% of that market? Like I actually think that's conservative. But when you think about how attractive digital credit is, and I'll give you some like a framework for this in a second, but 1% would be about double the current market cap of Bitcoin. And so you think about that, if $3 trillion flew into demand to buy Bitcoin from issuers like Strategy, like Strive, what would that do to the price of Bitcoin? It would not be a doubling, right? Because a lot of Bitcoin, like so many Bitcoins, they're just not for sale, right? There's going to be a amplified effect on the price of Bitcoin. It probably would send Bitcoin to $1 million just on its own, like because of how many Bitcoin are actually available to sell. Now, obviously that would mean massive growth and adoption of digital credit, But in the world of overall credit, 1%. That's nothing, right? And so you think about like, what does digital credit compete with? When we first started as an issuer, and I think this is, no one's perfect. And I think if I had to say one of my learnings in Bitcoin, I mentioned, I went all in on Bitcoin, by early 2017. When I first went all in on Bitcoin, I was super convinced of it being like the only solution to the debt problem. But at the time, I actually wasn't bullish enough on Bitcoin. And I had to, learn even that lesson, from my first allocation, right? Is like, oh, someday Bitcoin will be $100,000. Like, I didn't even have in my mental framework at the time that Bitcoin is going to go to infinity. And that it's not a trade, it's not a 5-year trade or a 10-year trade. It's a perpetual trade, right? Because there's no end to this, dying of fiat currencies. And so that bias of not being bullish enough also, I'd say, was a bias of mine, and I think a lot of others, when digital credit first started, is they viewed it as a better instrument relative to fixed income. But when you actually think about it, it's better than, you think about checking accounts. Checking accounts pay 0%. So why have zero when you could have 13% or 11.5%? It's a play versus stable coins. So the U.S. just is probably on the goal line of passing the Clarity Act, which mandates that you can't pay a yield on stable coins, which is just like kind of silly in a sense that the technology is there to pay a yield on stable coins, but why do they not want that to happen? Because if you paid a yield on stablecoins, you'd have a run on the banks and the dollar would collapse. So you can't pay a yield on stablecoins to try to keep this kind of house of cards together. It also obviously is, versus fixed income investments, versus preferred equity investments, versus dividend paying stocks. So dividend paying stocks, they don't on average have a return as high as normal stocks, but they pay a yield of 4 or 5%. Well, here you have a perpetual stock. So it's like, digital credit can go after all of these different markets, and it's just a functionally better offering. And so you think about how big this breakthrough is that in traditional, in any innovation, most innovations that are really 0 to 1 innovations, and that's what I view digital credit to be. Like, it didn't exist and now it exists. It doesn't just compete versus one thing. It's not like you had a car and now you have a better car. It's it's you did not have something and now you have something. And the reason that is the case is because of Bitcoin, number one, and because of the failure of fiat currencies. And so the last thing I'll say on this is that you think about, like, why does digital credit matter? Bitcoin is perfect money. I think we're moving to a Bitcoin standard over the next, the timing of this is really hard, but let's say the next couple decades. But the dollar is still the reserve currency today. And in this transition period, digital credit, I think, is the best way to have an asset that you can use with a shorter duration, right? That doesn't have the volatility of Bitcoin, that is both recognizing that the dollar is still the reserve currency today, and we're moving towards a Bitcoin standard in the future.
I love that. And like always, when I hear things like that, like nobody's bullish enough. It's like you always underestimate what Bitcoin will do in the future because you see what Bitcoin is today and you think Bitcoin will be a bit better in the future, but it's like completely changing the game. And obviously in the beginning, when it was a few $100, it was hard to see it at 100,000, and now it's like it's hard to not see it at 1 million, for me at least, and beyond. Let's talk a little bit more about the move to daily. I almost forgot about like the announcement, because I think it's a very important milestone in the SATA and Strive history. Why did you move from monthly dividends to daily directly? I know Stretch is moving from monthly most likely to semi-monthly. I think the voting is not done yet, but probably move to semi-monthly. So how is that possible, and why did you move to daily?
With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today. And you can make with that unlimited amount of backups. Go now to microseed.io. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together.
Yes. So from a first principle perspective, if you start from the viewpoint that what we just talked about, right now the dollar is the reserve currency of the world. We're moving to a Bitcoin future, and digital credit can help play an important role in that transitionary period. That if you basically want to make digital credit like a money market fund, like money, right? It's not money. It's not a money market fund for all the haters out there. I'm not saying it is, but if you want to make it basically as close to that as possible, or even better than that, right? The optimal dividend frequency is as frequently as you possibly can, because you don't want to make the dividend itself an event that you have to like think around, that you have to try to save around, that it just is a thing that happens. And so traditionally you think about dividends, they were used to pay profits, and so a company might pay them quarterly. They have paid monthly for a while, but most don't pay monthly, right? That's the exception, relative, not the rule in capital markets right now. Most pay quarterly or annually, and that makes sense for a company that's just trying to pay profits. But if you're not just trying to pay out your profits, but you view digital credit, so like we view SATA as our flagship product as a company. So like you think about any company that has a product, you want to do everything you can to make that product the best product you can, the most usable product. And if that product is maximally successful, then the company and the common equity will also achieve the most success it can. So we're sitting there asking ourselves, what do the SATA users want? What do we think makes the product better, more usable, solves problems that they have? And what we saw, and this wasn't an inefficiency, it actually makes sense, was that with monthly dividends, that into the dividend event once a month, the volume would spike because everybody wanted to collect that dividend. And then post dividend, the price would drop roughly, plus or minus depending on the month, by the amount of the dividend, which actually is like makes sense. Now sometimes it would drop less because there's more demand. Sometimes it would drop more because these people that were trying to arbitrage the dividend might have got burned. But like it would drop, and you would expect it to drop. And so that makes it more difficult to use it as money. Like when we talked about you talked about your friend and having some cash and then some digital credit. The closer, if that dividend is just a continuous stream, there's likely going to be less of a need to hold as much cash because the effective duration of the instrument of digital credit goes down. And so that was the driving force to daily dividends. I think Seyr has said if he could pay dividends every hour, he would pay every hour. And I agree with him, right? It's the same principle. It's like you're not trying to make the dividend event. You're just trying to make it a thing within the system. So that way you can use digital credit as we transition from a fiat currency system to a Bitcoin system. And so that was the why. The how was, we had been looking into, like strategy, more frequent dividend payments for months, right? Like we saw this as a friction point, the dividend event in digital credit. And we were talking with all of the different players. And so there's different players in the US capital markets that are, people that say that are the gatekeepers of how frequently you can pay a dividend. So our stocks, both State and Stretch, are listed on NASDAQ. So NASDAQ is one of the players. DTCC, which is a clearing corporation that actually pays out the dividends, they're another important player in the system. The transfer agents that actually account for the stock on record. So we use one called VStock. They're another player in the system. Then you have lawyers and all these different people. And so our question was just like, how frequently can we pay dividends? And the first thing was, well, you have to have at least 10 days before when you record a dividend. So when you announce a dividend, you record a dividend. So you had to provide a notice period to NASDAQ. And so the question that our team asked, and so when Strategy announced semi-monthly, we weren't convinced that daily was possible, but we were looking into it seriously, which is why we just kind of went quiet, because we were trying to understand. Like we weren't. It was possible that semi-monthly was the most that would be possible for us. It was possible that more. So we were just trying to understand. And so we pushed both NASDAQ and DTCC. Is like, can we just announce, like, call it mid-May. So can we announce all of the dividends for June, every business day, and do it more than 10 days in advance. So that way you got your notice period. But then once we're in June, we'll record a dividend every business day and pay it out the next business day. Can we do that? And it was kind of like a puzzled look initially, because it was like, they're thinking in the old framework, companies paying profits, that like, why would you want to pay a daily dividend? Like, what does that even do? But they're like, like, I don't see why you couldn't, but like they all wanted to talk to each other. And so Jeff Wallen came up with the concept of, it was like this, like the Spider-Man meme. I don't know if you see, there's like 3 Spider-Mans and they're all pointing at each other. And we had basically the transfer agent, NASDAQ and DTCC all saying, well, if they don't say no, we won't say no. But none of them would say yes. And so that was kind of like where we were for like a period of like about a week and a half. And so we had to, get all of them in a room talking. And then they all went from, if they don't say no, to like, they all said yes. And so that's how we were able to innovate and do it. And I think if you were to look years into the future with tokenization, I would suspect that daily dividends business days is probably not the end state. It's the current best state for how frequently it can be paid, on a path to pay more and more frequently into the future.
I love that. It reminded me on that meme that, and I think most people probably in their childhood have gone through that, asking, like what you want to do something as a kid, and you're not sure if the parents say yes. You try to go to the parent that will most likely say yes, and you go there and like, yeah, if mom says yes, then I'm okay with it. Then you go to mom, like, okay, if dad is okay with it, I'm okay with it, kind of a situation. That's funny, that's interesting. But it's crazy that this, like, you basically now created the company, the first company that is paying out a daily dividend business days. So like not not celebration days or holidays or like Saturday, Sunday, but like every single business days, which is I think like 250 days a year dividend.
On average.
That's crazy. Like that, like I love that Bitcoin is always the ones that are innovating and pushing the needle forward. And TradFi is like, why do you want to do that? Like, what is going on? Like, okay, I guess you can do it, but like, why?
Yeah, exactly. And I like that you said, Bitcoiners, because I think it's important is that I view this as like foundation building, right? And as a Bitcoiner, like I don't find value in other altcoins, right? And the reason is that I view Bitcoin as a foundation, like a sturdy foundation to build on top of, right? And I think that's the difference here, is that when you take a sturdy foundation, the best money, then you can build on top of it and solve different problems for different people. And I think that'll always be true. And it'll also be true that certain people will build, bad things on top of it. Just like you can build, you could take a foundation of a rock and you could build a crummy house on top of it, right? That's possible. You can build something crummy on top of Bitcoin, but you can also build the most beautiful things on top of Bitcoin, right? Where if you take a foundation that's not sturdy, so whether it's the dollar or whether it's an altcoin, and you build on top of it, it's always going to be a house of cards, right? That's one crisis away from it being blown down. And I think what you're seeing here is you're seeing kind of, and I think you'll continue to see this, the acceleration of innovation on top of Bitcoin. And so I'm sure you've seen the Hal Finney commentary on Bitcoin banks in the future, something that he predicted to be true. I think digital credit is the first real version of a Bitcoin bank, and it's structuring around Bitcoin. Now, obviously, with SATA, you don't have a claim on the Bitcoin. You can't take the Bitcoin back, so that's a difference from a bank. But then the reward for that is probably the highest interest rate of a Bitcoin bank, right? That because you don't have a claim on it, you get the highest potential reward in terms of a yield. And I think that's part of the innovation layer that we're starting to see, and it's going to be financial innovation, right? Like all of us finance and math nerds can go out and try to innovate and provide products that both solve problems but also drive demand and adoption for Bitcoin. And I think that's one of the things that you'll continue to see. And I think the reason you'll continue to see that is because of how great Bitcoin is, right? That it's too great of an asset for companies to not want to innovate on it, countries to not want to own it when they see it as the solution, right? And I think right now you're still seeing kind of the end innings of certain nations maybe trying to fight against it in different ways and preserve their own currency, but Bitcoin doesn't care. It's gonna win.
I very much agree with that. Now it's very early. It just happened, I think, like 2 or 3 business days or 4 business days or something like that ago. But do you already see like early indicators on why it was a good move? Something that you see like gives you already kind of a indication that it was a very good move. I mean, the implementation of daily dividends, I think, comes in June only, so like it's still a little bit out to actually see. But do you see kind of the feedback of the market already?
Yeah, so the volume in SATA spiked massively when we announced daily dividends, and it snapped back to trading at par, which that nuance to the dividend schedule, right, where we were talking about a little bit ago, where after the monthly dividend, the price would drop and then it would work back into par leading into the next record date. And you're seeing similar, as we're recording right now, we're right after the record date for strategy stretch, and it dropped a little over $1, right? And the dividend is right around $1. And so we snapped back 2 weeks early, which shows substantial strength. Today, we announced buying over $30 million of Bitcoin, which for us, if you actually compare, on a relative sized strategy, that would be equivalent to strategy announcing about a 20,000 Bitcoin buy, which would be a very large buy for strategy on a non-record date week. And that was driven almost entirely from SATA issuance. And so a lot of demand, but to your point, daily dividends don't start until mid-June. And so our next record date at the end of May will actually be our last monthly dividend record date. And so for people that are, and then we won't start paying daily till mid-June. And so I think what we're seeing right now is just the anticipation of the excitement of daily dividends. But when you're actually paying them, that is what will show the ultimate success. But I think early days are showing that a lot of excitement and demand around it. And I think when you go on top of that, of like the innovation layer, and so one of the innovation layers happening is on chain. So like on like on Ethereum or on Solana, where basically they're creating digital credit to compete with stablecoins, right? And so stablecoins are hundreds of billions of dollars, right, on all these different chains, right, and a massive demand. Why is there demand for stablecoins? I think the biggest source of demand is people that live in third world authoritarian type sort of countries that want access to outside of their system, outside of their own currency, and they want dollars. I think that they're going to find digital credit to be better. And so I think that you're going to see on-chain demand for digital credit explode as it provides a solution to these individuals that just want to be outside of their system and want something that doesn't have a ton of volatility. And we're seeing, but their biggest risk is actually the dividend event. So we've heard a lot of positive feedback on the move to daily dividends from there as well.
Now, one other thing that I think this year actually happened for Strive was the merger with Semler Scientific, and I think this was the first big news or the first big milestone that I heard about Strive. As I said in the beginning, I'm interested in Bitcoin Treasury companies only since December, so it's like a very short history. I'm trying to catch up as fast as I can, but there's a lot to learn. Um, what was the thinking process behind Semler Scientific, and what does this bring to your business for Strive?
Yeah, so that was in late 2025. We announced and then quickly closed the first merger when we acquired Semler Scientific. The idea was that we already knew we were all in on digital credit, and we wanted to be all in on SATA. And there kind of became a minimal, in our view, optimal size, right? And so you talked about management team risk. There's also just embedded cost structures in running a public company, right? That like it doesn't matter if you're a super small public company or a massively large public company, to do all the regulations and work with the SEC, work with the exchange. There's just a lot of embedded cost in that, right? In the millions of dollars per year. And so the idea was that our view was that around $1 billion of Bitcoin was the minimum size where those costs aren't an issue, right? Like they don't materially drag the performance of the company. And so we needed to achieve a bigger scale quickly, or we were going to be it was or the size of our company was going to be a constraint on the attractiveness of our digital credit offering. And so that was why a merger made sense, because we before the merger, we had just over 5,000 Bitcoin. That basically doubled our Bitcoin stack. You add on the SATA issuance, and now we're over 15,000 Bitcoin. But we needed to kind of scale up, right? And this is when Bitcoin was over $100,000. Right now it's 76,000. But like even then, when it was much higher, we knew we needed some more scale. So that was the concept behind why the acquisition made sense. Semler, importantly, their shareholders actually turned down their ability to do digital credit. And so they viewed digital credit as where it was going as well. They were not going to be able to because they had existing debt. They were too small. Their shareholders, because of those reasons, didn't feel comfortable with them. And so they were in a need to either dissolve or be acquired. And we were, as they saw us as the potential leader in digital credit. So it was a win-win on both sides. We acquired their Bitcoin at a slight discount. So it was an accretive transaction to Strive shareholders. And it was also accretive to the Semler shareholders because they were kind of stuck in what they could do. And so that's why it was a win-win. And what I think you've seen in the ecosystem since then is, right now it's only Strive and Strategy that have publicly listed digital credit offerings. And not to say that will always be true, because I think there's other issuers that are looking to get out there. But it's harder than I think people thought it would be. I think people were expecting after Stretch for there to already be 10 companies with publicly listed digital credit offerings. And the reality is it's hard, but not impossible. And so I think ultimately where you go is I think there'll be multiple issuers of digital credit. Just like there's multiple banks, there's multiple insurance companies. All right. And for the average person, they might look at, what's the difference between Wells Fargo and JP Morgan and Bank of America. And if you ask the average person, they might say, I can't even tell you the difference. These are all companies that have, trillions of dollars on their balance sheet. And there's multiple reasons why there's a need for multiple companies to exist in the space. And it's why when you kicked off our podcast today, you talked about how Strategy and Strive are not competitors. We don't view each other as competitors. Like we legitimately do not. Like when and even to the extent that we have a strategy executive on the board of Strive, Sharish Jajodia. Like people that think that we are secretly competing and wishing each other failed, it's just not accurate. And the reason is it's so early that there's substantially more to be gained by growing the pie, growing the ecosystem together, than to have fierce competition. I would say it's friendly competition. It's kind of like, if I see someone buys a bunch of Bitcoin, I want to buy more than them, or whatever. But it's done from a spirit of friendliness, where if Strategy, if they buy another million Bitcoin, and they push Bitcoin up to $1 million a coin, Strive stock's going to do really well. And I think that's just the bottom line. It's that if a bunch of Bitcoin treasury companies blow up, that's not good for Strive, even if we're sound as can be, right? It puts a stain on the ecosystem. And so we really do want each other to win. We really are cheering for each other. We also, I'm deeply convicted that Strive has the optimal capital stack. It's super simple. We have no debt. We have a lot of amplification. And we could, debate those more as like friends of like, why do I believe Strive's business is better than 21's as an example? Why does Jack Mallers believe his is better than Strive's, right? Like those are debates that each of us really believe to be true on each side, right? But at the core, we're both Bitcoiners, and I want 21 to win. I want them to build a great Bitcoin business, right? I think Bitcoin needs great Bitcoin businesses out there, and I think they could be wildly successful. And we'll both think that, and have passion that what we're doing is the optimal way. And that's what makes capital markets fun. That's what makes business fun. But it is truly, I think, one team, one dream at the end of the day.
I love that. And I mean, and you already see it happening. I mean, Strategy, I don't know if this is correct, but Strategy paved the way for digital credit with Stretch, and now Strive paved the way for daily dividends. And so like Strategy is benefiting from multiple players, because it's the same with Bitcoin, that there's no head to attack. If Strategy is the only player that does that in the Bitcoin ecosystem, it's an attack vector also. If there's like 10 companies, 20 companies that do the same thing, and there's like a huge ecosystem around that, killing the whole ecosystem is a lot harder than just killing one company. So even from a game theory aspect, if you just root for Bitcoin, you want there to be as many heads to attack as possible, because then it's almost impossible to attack them all, if you get what I'm saying.
Yeah, I totally agree. And I think the, one other additional layer on that is it's important that there's international Bitcoin treasury companies as well that are successful. And obviously we see a bunch of international Bitcoin treasury companies right now. On the digital credit side, you have not seen an international one launch one. I think that'll change in the future, but you're seeing some of the challenges. They're not insurmountable challenges, but some of the challenges some of these international players are going through, working through the regulatory environment, the most often more antiquated capital markets in some of these different international systems than in the United States. And those are real challenges, ones that very smart people behind some of these companies are working through, and ones that like Strive would be like wanting to help them work through, right? Because to your point on the attack vector, like if you had digital credit issuers, I mean, like who doesn't want a daily dividend that pays double digit rates? I mean, there's a ton of people, but who wouldn't want one that pays in yen? Who wouldn't want one that pays in the pound? Who wouldn't want one that pays in the euro, right? Like these would be different products, right? That would appeal to the people in those different countries in a way that, being paid in dollars will still be attractive to a lot of people in international markets, and we're seeing that. But there's clearly a demand, I think, for these additional digital credit products, and helping these companies work through these, and being part of this ecosystem, I think is critically important, because if you had 25 different markets that all offer digital credit, what head do you attack, to your point?
Yeah, it's like it makes the whole thing way more like stable and decentralized, on top of Bitcoin even. Um, I have one question to ask each and every one of my guests, and it's a question of what can we learn from you besides Bitcoin? And feel free to go in any direction you want to go with it.
Yeah, often I go in my faith as a Christian. I'm going to go a different route today, and it's something that I think is true with Bitcoiners. But I have two little kids, and highly recommend that people have kids, have them young, get married, have kids. And I think our society has trained people to go to college, get a job, figure out your life, wait, wait to have kids. And I actually think that is a mistake in life, and you're seeing it in birth rates that are declining. I think we have a fertility crisis, and I think there's multiple reasons for that. But I think part of it is just people feel like they can't afford to have kids. And so the whole point of, Bitcoiners say, and I believe this, fix the money, fix the world. Well, if the point is only to fix the money to be wealthy, I think people are missing the point, right? It's the concept of the person that, lives their life, they gather a bunch of money and they become super rich, and they end up at the cliff and they die, right? Like the point is to fix the world, to live a great life, right? And to have the freedom that people get by being a Bitcoiner, and by being part of helping fix the system, fix the money, and getting wealth to actually live a better life. And I think a core part of that for most people, if they're able to, is to have children. And I think that I would like nothing more than to have the world populated with children from Bitcoiners that understand the system, and that will make the world better. And so that is my advice.
Plant some more Bitcoiners in the world. I love that advice. Really cool. We have an end routine as we are slowly getting to the end of the podcast, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. It's an interesting one. It's one that I couldn't answer because I was too young for that. I hope you still remember. Where were you, and what memories do you have of when 9/11 happened?
Yeah, I was in high school, and so I grew up as a Mormon. I'm no longer a Mormon. I'm just a Christian. But I was on my way to Mormon seminary school in the morning, driving, listening to the radio, and that's when I learned about 9/11. And obviously, it was a a sad day, a memorable day, a day we'll never forget. But that's where I was.
Nice. Really cool. Thank you so much, Matt, for being on the podcast. For people that are interested in Strive, or interested in you personally, where can they find the company, and where can they find you personally?
Yeah, so the Strive website's just strive.com, and then the easiest way to follow us is on X. So on X, I'm at Cole Macro, ColeMacro, and then Strive is just at Strive on X. And we do drop a lot of alpha, a lot of math nerdy stuff. So if you want to follow us closely, that's the best way.
Awesome. Then thank you so much, Matt, for being on the podcast. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.